Thank you for coming to Company D's business policy presentation. This presentation was created by Ashley, Mercedes, and Leslie. Ashley will start us off with our strategic vision.
Thank you for the introduction, Mercedes. So our goal is to position Company D as a global leader in delivering technologically advanced drones and cameras that balance innovation with affordability. We are committed to continuously improving product quality while ensuring that our prices remain accessible to a wide range of consumers. By expanding our product offerings and strengthening our market presence in both premium and cost-sensitive regions, we aim to build a brand known for reliability, value, and customer satisfaction. With our strategic vision as the foundation, I'll now have Leslie walk you through how we executed our best cost strategy to balance affordability and quality in all our markets.
Thank you, Ashley. To achieve a cost-based competitive advantage in the marketplace, our best cost strategy focuses on producing goods for a wide range of buyers at a lower overall cost than competitors. This approach enhances our ability to drive efficiency improvements, thereby increasing profit margins. We aim to expand our private label offering by actively recruiting additional retailers and increasing the number of retail locations. In addition, we will provide robust retailer support to strengthen partnerships and drive sales growth. Our competitive sales promotions will further support these efforts. We plan to increase our advertising budget and enhance our online presence through improved website displays. This will drive greater brand visibility, attract more customers, and continue to overall sales growth. Our efforts to date are highlighted by our achievements in the next slide.
Thank you, Leslie. Now, as for our achievements, our team achieved incredible progress during the simulation. Let's start with financial growth. Our EPS skyrocketed from $1.24 in year 6 to $14.07 by year 15. And our return on equity hit an impressive 67%, showing us just how efficiently we used our resources. Our stock price also climbed from $27.38 to $358.90, proving investor confidence in our strategy. Now, when it comes to market share, we're proud to say we held above average shares in all regions by year 15. For cameras, we reached an 18.9% market share in Latin America, the highest among all regions, and saw consistent growth across North America, Europe, Africa, and Asia Pacific. Now for drones, we hit about 15.5% in North America and 16.5% in Europe, Africa, demonstrating our strategic success. Now, product excellence was another key achievement. By year 15, our cameras reached a PQ rating of 6.1 stars, and drones followed closely with 6 stars. This reflects our commitment to balancing innovation with affordability. Lastly, our camera contract wins were a major highlight. We secured significant deals in all regions, boosting sales and reinforcing our market presence. These wins showed our ability to deliver affordable, high-quality products that meet customer needs. I did include a screenshot of year 15 contracts for our company in Latin America to showcase how these contracts did indeed help us. Together, these achievements demonstrate the power of our strategy and execution during the simulation. Now, while we're proud of the progress we made and the milestones we achieved, the journey wasn't without its hurdles. Let's take a closer look at some of the challenges we faced and how we worked to overcome them in the next couple of slides. So our team faced several challenges during the simulation that tested our strategy and problem-solving abilities. First, balancing costs and profitability was a major hurdle. Early on, our low pricing strategy compressed margins, making it hard to maintain profitability. To address this, we invested in robotics to cut costs and made some incremental price adjustments, which helped improve our margins over time. Next, we had to deal with intense market competition, especially in high-growth regions. Competitors were aggressive, but we responded by focusing on targeted marketing, adjusting our pricing, and improving product quality to stand out. Production efficiency was another area where we struggled initially. High labor costs and inefficiencies in production slowed us down, but through some investments like robotics and some worker training programs, we were able to streamline operations and boost productivity. Finally, adapting to regional challenges proved to be tricky. Customer preferences varied widely across regions, so we ended up implementing region-specific marketing and pricing strategies to better meet local demands. Now, these challenges were difficult, but they ultimately pushed us to innovate and improve, helping us grow as a team and refine our approach. Now that we've explored our achievements and how we approach challenges, I'll hand it over to Leslie, who will dive deeper into our production strategies and how we stayed competitive in a dynamic market.
Within our plant, the integration of robotics has significantly enhanced production efficiency, reduced labor costs, and increased output. Our facility boasts an above-average number of workspaces and workstations, contributing to a notable increase in overall capacity. This expansion has directly supported sales growth and profitability. Additionally, investments in plant capacity have facilitated key contract acquisitions, positively impacting market share. Our workforce compensation package exceeds industry averages, offering a 4% annual raise, assembly quality incentives, attendance bonuses, and competitive fringe benefits. These initiatives have significantly contributed to higher workforce productivity and have enhanced the company's reputation. We make regular investments in employee training to bolster productivity, quality, and operational efficiency. Our commitment to continuous learning supports the development of a lean environment aimed at eliminating waste and driving sustained improvements to the bottom line. Now let's take a look at our direct competitors. Our prime competitors for cameras are companies G and E, and our drone competitors are primarily companies E, F, and G. In both North America and Europe, we were able to secure a blue market and larger market share for drones. While in Asia Pacific, we maintained a blue market for camera and a larger market share for drones. In Latin America, we held larger market shares in both cameras and drones against some direct competitors as well. Our growth will continue as shown in our long-term strategy in the next slide. Our long-term strategy is to develop, grow, and sustain. Yearly increases in marketing, retailer recruitment, and contract wins in conjunction with sales promotions are pushed to increase sales volume. It is our goal to build our image rating and establish customer loyalty to eventually gain access to economies of scale. Our increase in quality will warrant price increases while remaining competitive, and paired with loyal customers will create growth long term. Lastly, we plan to strive to live in a blue market to diversify D Company from other competitors. Let's now move on to our financial performance.
Thank you, Leslie. Our financial performance shows a steady increase from year 5 to year 15. There were quite a few noticeable metrics, including operating profit. We saw a 823.5% increase. Net income saw a 1,360.4% increase. Earnings per share saw a 1,874.7% increase. And our debt to equity ratio changed from 59 to 41 in year 5 to 21 to 79 in year 15. The company's credit rating improved from B in year 5 to A in year 15, reflecting better financial health and reduced risk. North America remains the dominant region, but all regions showed strong growth, especially Latin America, which saw a 335.4% increase in revenue. Some of our growth drivers included in year 5, revenue from our cameras was $186.64 million, and our drones was $145.49 million. In year 15, cameras made $499.33 million, and drones made $508.85 million, overtaking cameras as our best seller. Capital expenditures in year 5 were $20 million, and in year 15 it was $15.57 million. The slight reduction may indicate stabilization of infrastructure or a shift toward operational efficiency. The last few slides will include our lessons learned.
Thank you for sharing, Mercedes. This simulation gave us valuable insights into crafting and executing a strategy, especially when starting from a challenging position. One of the first things we realized is that having a clear focus makes all the difference. By prioritizing cost leadership and quality improvement, we were able to steadily drive progress, even from being at the bottom. Flexibility was another key lesson. Adapting to regional needs and learning from competitors allowed us to stay competitive in a dynamic environment. Consistency also paid off by sticking to our strategic decisions like maintaining affordability and improving PQ ratings. We achieved measurable results over time. So the biggest takeaway is that success isn't always about being first. It's about staying committed to your plan, learning from setbacks, and keeping a positive and determined mindset. That approach helped us overcome lots of challenges and move forward throughout the simulation. Now, while I've highlighted some broader lessons about strategy and resilience, another key area of learning came from managing stockouts. To explain what we learned and how it impacted our performance, I'll pass it over to Leslie.
Thanks, Ashley. Another lesson learned for our company is regarding stockouts. When bidding on contract sales, it is essential for the company to ensure that its operational capacity can support both the immediate contract requirements and anticipated increases in sales volume. While we successfully secured contracts through competitive product offerings and price strategies, we encountered unforeseen stockouts in year 13. To address this challenge, we made additional investments in workstations and workspaces, which effectively mitigated stockouts in both year 14 and 15, ensuring a more resilient and scalable production capacity moving forward. Lastly, our financial lessons learned are highlighted next by Mercedes.
Our final lessons were on the financial side, including focus on high growth markets. In year 5, AC cameras accounted for 56% of revenue, but by year 15, UAV drones became the dominant driver, contributing slightly more than the cameras. Our lesson in this was diversifying product lines and focusing on markets with higher growth potential can yield substantial revenue increases. Our second lesson was improved operational efficiency. Our operating profit margin grew from 10.1% in year 5 to 31% in year 15, showing a 20.9% growth. Our asset turnover also improved. Efficiently using assets to generate revenue increased the turnover ratio from 1.21 to 2.14. The lesson from this was streamlining operations, optimizing production costs, and enhancing asset utilization are critical to driving profitability. And our last lesson was reinvestment over short-term periods. Reinvesting profits into the business rather than distributing them to shareholders and dividends supported long-term growth. We also reduced our debt. The debt to equity ratio improved dramatically, showcasing a focus on financial stability. The lesson from this is prioritizing reinvestment and managing financial leverage efficiently and effectively can sustain growth and create shareholder value in the long run. Thank you for attending the Company D presentation. We look forward to a Q&A session offline.